In 22 months, the global market for government bonds lost $25 trillion. This figure is larger than the entire annual economic output of the United States. The losses did not come from risky stocks or unproven digital currencies. They came from safe government bonds, the foundation of the world financial system. Most investors believe these bonds are as safe as holding physical cash. When the value of these bonds drops, the math behind every bank changes. This did not occur because of a single mistake or a specific villain. The system behaved exactly as it was built to behave under high-velocity pressure. This is the hidden danger of time and changing interest rates. For 40 years, the financial world followed one very simple rule. Interest rates kept falling, and inflation stayed very low for a long time. In this world, a government bond was considered a mathematical guarantee. You give the government money today, and they pay you back later. Because a government can always print money, the risk of default is zero. Banks and pension funds treated these bonds like perfect, unbreakable safety nets. They used these bonds to back the savings of millions of people. The system was built to reward people for locking their money away. As interest rates fell towards zero, the market price of old bonds rose. By 2020, investors were actually paying governments to hold their money. The system worked because everyone expected interest rates to stay low forever. The entire global economy was optimized for a world that has vanished. The rules changed in 2022 when global inflation suddenly returned. Central banks raised interest rates faster than they had in 40 years. This created a direct conflict between old debt and new reality. If you own a bond paying 1%, nobody wants to buy it. They would rather buy a new bond that pays 5% interest. To sell your old bond, you must lower the price significantly. The longer the time left on the bond, the more value it loses. A 30-year bond is like a seesaw. A small rate move creates impact. In 2022, these safe bonds lost 30% of their value. This created a massive, invisible hole in the balance sheets of banks. The safest asset in the world was suddenly losing more than stocks. Banks were holding trillions in assets that were worth less than before. As long as no one asked for their money, the hole stayed hidden. But banking is built on the promise that you can leave whenever. Consider a single chief investment officer at a regional American bank. He is a person whose job is to manage billions in safe money. In 2021, he faced a constraint. His bank had too much cash. With interest rates near zero, that cash was earning almost nothing for depositors. To generate a tiny profit, he decided to buy long-term government bonds. He was not being greedy, he was following the standard industry manual. He locked in a 2% return for the next 10 years of time. He believed he was protecting the bank and the community it serves. When interest rates spiked to 5%, his safe choice became a liability. His phone began to ring as large depositors asked for their cash back. To pay them, he had to sell those bonds for 70 cents on the dollar. The loss was not caused by his character, but by his constraints. He realized a billion-dollar loss because he could not stop the clock. The depositor absorbed the risk that was built into the timing of the system. Every modern economy is built on a series of promises about time. The bank promises the depositor that their money is available this afternoon. The bank also promises the government it will hold debt for 10 years. These two promises are in direct mathematical conflict with one another. When interest rates are stable, this conflict remains invisible to the public. But when rates move, the distance between these two promises creates heat. The heat is felt first by the managers of the largest pension funds. These managers are responsible for the retirement checks of teachers and firefighters. They are forced by law to invest in safe, long-term government debt. When the value of that debt crashes, the pension fund appears to shrink. To fix the shrinking balance, the manager must find cash immediately. Often, the only way to get cash is to sell the bonds at a loss. This creates a cycle where selling causes prices to fall even further. The safety of the retiree is managed by the math of the system. This trap was not an accident. It was a requirement of low rates. When rates are zero, investors have to take more risks to grow. A pension manager must buy 30-year bonds just to pay retirees. This creates a fragile foundation for the entire global financial stack. We saw this in the United Kingdom during their 2022 pension crisis. Funds used complex bets to protect themselves against low interest rates. When rates spiked, those bets required immediate cash that the funds lacked. They were forced to sell their safe bonds, which crashed the price further. This created a circle of selling that almost broke the British economy. This did not happen because someone stole money or made a mistake. It happened because the structure behaved as designed under high pressure. The search for safety in a low-rate world created the current danger. Today, global debt is even higher than it was before the crash. The trap has not been removed. It has only been moved elsewhere. The mechanism of this crisis is built into the definition of a bond. A bond is simply a contract that pays a fixed amount of cash. If the cost of living goes up, that fixed cash buys fewer things. Therefore, the bond must become less valuable to anyone holding it. This is the invisible change that inflation brings to the entire world. In the past, banks could hide these losses using accounting loopholes. They were allowed to pretend the bonds were still worth full price. They called this held to maturity, a label that suggests permanent stability. But a label cannot stop a depositor from wanting their money back today. When the line at the bank forms, the accounting fantasy must end. The executive at the desk is forced to face the real market price. At that moment, the risk-free asset reveals its true, volatile nature. The losses are real, even if they were not recorded on the books. The system is designed to delay reality until it becomes unavoidable. We must look at the incentives that drive these institutional decisions. Regulators encourage banks to buy government debt over any other asset. They do this because it makes it easier for governments to borrow money. The bank is rewarded for being a loyal customer to the sovereign state. This creates a massive concentration of risk in one single type of asset. When everyone owns the same thing, everyone tries to sell at once. There are not enough buyers in the world to absorb 25 trillion. The central bank then has to step in and provide liquidity to help. This printing of money is a structural reaction to the initial inflation. This creates a reinforcing structural feedback loop within the monetary system. The institutional architecture reallocates losses through fiscal and monetary channels. The individual person at the end of the chain is the one who pays. Consider the perspective of a grandmother living on a fixed pension. Her fund manager tells her that her retirement is safe and secure. He does this because he is holding high-quality government securities. He does not mention that those securities have lost a third of their value. He does not mention that the fund is one requirement away from selling. The grandmother feels safe because she does not see the structural cracks. She assumes the risk-free label means her life will not change. But the math of duration does not care about her plans or her age. If the system needs liquidity, her future is the first thing to be sold. This is the human scale of a $25 trillion loss. It is not just a number on a screen. It is the erosion of security. The structure behaves as designed, regardless of the human outcome. Danger is rarely found in the things that everyone is afraid of. It is found in the things that everyone assumes are perfectly safe. When an asset is called risk-free, people stop checking the locks. This leads to everyone crowded into the same room at once. Fragility is the result of being too comfortable for too long. The loss of $25 trillion was not a system failure. It was the market forcing the system to face the cost of time. The risk did not go away, it just moved through the structure. The system did not fail because people lost heart or did wrong. The structure was built to break under this specific pressure. In the final analysis, we must recognize the design of the trap. We have built a world that requires interest rates to never go up. We have filled our banks with debt that cannot handle the light of day. The executives, the regulators, and the allocators are all in this structure. They are following a manual that was written for a different era. They are making rational decisions inside an irrational architecture. The next time you hear that an investment is completely safe, look closer. Ask who is holding the risk of time and who is holding the cash. The answer is usually the person who can least afford to lose it. The mechanism is clear, the incentive is set, and the pattern repeats. The risk of safety is the most expensive risk of all. Imagine a city built entirely on a frozen lake during a long winter. For 40 years, the ice has been thick enough to support skyscrapers. The engineers have stopped testing the depth because it has always held. They have built their entire infrastructure on the assumption of permanent cold. One year, the temperature rises by only a few degrees for a week. The ice does not disappear, but it loses its structural integrity and strength. The skyscrapers begin to tilt, not because they were built poorly themselves. They tilt because the foundation they were forced to use is changing state. The engineers try to pump cold water into the lake to stop the melting. But the act of pumping requires energy, which creates more heat in the city. This is the exact position of the modern central banker today. They are trying to stabilize a system that is naturally trying to adjust. The $25 trillion loss is the sound of the ice cracking. The inhabitants of the city are told to stay calm and remain inside. The laws of physics do not respond to reassuring public statements. The foundation is moving, and the city must eventually reflect that reality. We are witnessing the transition from a world of debt to a world of cost. The transition is painful because it contradicts the initial structural premise. The global financial system is currently in a state of suspended animation. Governments have stepped in to guarantee the losses of the large banks. They have created new programs to lend money against the old dead bonds. This allows the banks to pretend that the $25 trillion still exists, but in reality, that value has been transferred to the future generation. It will be paid back through higher taxes, lower services, and less growth. The risk-free asset was never actually free, it was just a delayed bill. The bill has now arrived, and it is being delivered to every household. The institutional documentary of this era is not about greedy people. It is about the refusal to accept the mathematical reality of time. It is about the structural requirement to maintain a useful lie. As the lie becomes more expensive to maintain, the system becomes more fragile. Eventually, the cost of the lie exceeds the value of the system itself. At that point, the structure resets, and a new archive begins. The goal of this institution is to document that reset as it happens, to set the constraints clearly before they become catastrophic events. To understand the scale, consider the impact on global infrastructure. When the risk-free rate rises, the cost of building everything rises with it. Bridges, hospitals, and power plants are all funded by long-term debt. If the price of that debt crashes, the projects themselves become unviable. Future capital allocation capacity is reduced by this sudden increase in cost. The $25 trillion is a measure of lost economic potential. It is the wealth that would have been used to innovate and build. Instead, it is being used to fill the holes in old balance sheets. This is the ultimate consequence of mispricing the risk of time. We have spent decades consuming the stability of tomorrow to pay for today. Now tomorrow has arrived, and the price is higher than the current capacity. The institutional memory must record this period as a warning to the next. We must learn to value the constraints of the system over the promises. We must learn that safety is a dynamic process, not a static product. The archives show that every system built on a mismatch eventually breaks. The only variable is the amount of volatility during the transition. By documenting the mechanism, we hope to clarify the transition next time. By revealing the incentives, we hope to change the design of the future. The work of the institution continues as long as the patterns repeat. Finally, we must examine the basic concept of the insurance rule. In most systems, you pay a small fee to protect against a large loss. In this financial design, the rules were flipped by the mechanical requirements. The banks secured a small profit today by creating a massive risk for later. They ensured their current earnings by using the future of interest rates. The average person was never told they were part of this structural insurance. When the market moved, the system collected on the policy that exists. This is not a character flaw of the bank, but a feature of the design. $25 trillion loss is simply the premium being collected now. Until the design changes, the same bill will be delivered again and again. The institution documents these patterns so they can finally be recognized. Knowledge of the mechanism is the only true form of protection left. This is Luxona.